regarding bills of exchange? Did you try any problems? Okay, today we shall see the consignment accounts. Consignment accounts. So what do you mean by consignment? Do you have any idea regarding consignment?
No, ma'am.
Okay. I'll be sharing the screen. Now, consignment. So due to increasing size of the market, sometimes it is quite obvious that manufacturers or wholesalers cannot approach directly to the to every customer. Sometimes they may be selling their goods in different states all over the nation. So they may not be able to approach these customers. So in order to overcome this limitation, these manufacturers normally appoint reliable agents at every desired location to reach the customers directly. So sometimes these makes they make an agreement with local traders who can sell goods on their behalf on commission basis. So that type we call it as consignment. That means here consignment is a process under which the owner consigns or handovers his material to his agents, salesperson or salesman for the purpose of shipping, transfer, sale, etc. So here consignment is a process under which the owner consigns, handovers his material. So the manufacturer or the seller or the owner of these goods may be at one place. So around that place, he can sell the goods directly to the customers. But if he wants to transfer his goods to other location, sometimes he appoints some agents or the salesman, and he will be handing over his material to those persons. So on behalf of this person, that is the owner, they will be selling the goods on commission basis. So that we call it as consignment. Now let us see the features of consignment. Okay, so here ultimate ownership of goods remains with the manufacturer or wholesaler. So he will just transfer the goods, but he does not transfer the ownership. So on behalf of this person, they will be selling the goods. These agents or salesmen will be selling the goods. And since this ownership of goods remain with the manufacturer, so we call them as consignor. So if a person is transferring his goods to the another person to sell his goods on his behalf, we call that person as consignor. Consignor. Okay. So the owner of these goods or the manufacturer is called the consignor, wherein the person who receives the goods and who sells on behalf of the consignor, we call that person as consignee. Call that person as consignee. So here this consignee or the agent is not responsible for any loss or destination of goods. One is they do not have any ownership, and the other one is here ownership remains with the manufacturer, then this consignee is not responsible for any loss or destruction of goods. Okay. So here consignment is merely a transfer of possession of goods, not an ownership. And the other one is the goods are sold on owner's risk, and hence profit or loss goes to the owner. So if you take the goods or these goods will be sold on owner's risk. Hence, any profit or any loss that was incurred during the process, that risk or profit will be taken into the hands of the owner. It will be transferred over to the owner. So it goes to the owner. And coming to the another feature, consignee only gets reimbursement of expenses incurred by him and commission on sale made by him. So consignee only gets reimbursement of expenses. Whatever expenses this consignee incurs, those expenses will be reimbursed by the consignor. And he will be paid commission made by him. So whatever goods he sells, they will be agreeing upon a certain commission. So that commission will be paid to this consignee. Understood? Because the sales proceeds belong to the owner. Okay, so these are the features of consignment. Now let us see what is the difference between consignment and sale. Consignment and sale. So there are certain reasons why consignment is different from sale. Now let us see that. So if you take this ownership, the first difference between the consignment and sale is the ownership. So ownership of goods need to be transferred from seller to buyer in case of sale. Suppose if it is a sale, the ownership will be transferred from one person to the another. Suppose if we go to a shop to purchase some article. So you will be paying the amount. The person who is selling will be handing over that article to you. So you will be the owner of that article. So that we call it as sale. Here in sale, ownership of goods will be transferred from seller to buyer. Whereas in consignment, ownership of goods remain with the consignor. Ownership of goods remain with the consignor till the goods are sold by the consignor. So if the consignee sells the goods, the ownership will be transferred to the purchaser. But here ownership may not be transferred to the consignee. Until and unless these goods are sold to the other person, the ownership will be transferred from consignor to the purchaser. Till then, the ownership will be remaining with the consignor. So coming to the other difference is the risk. So in case of a risk, normally risk remains with the consignor in the event of goods being lost or destroyed. Suppose if the goods are lost during transit, or it may be suppose it may be destroyed by fire or something else, or some natural calamities. So thus that risk will be bared by the consignor, but not the consignee. Sometimes the goods may be in the handover of this consignee, but the destruction might have taken place due to fire or something else. As he is not the owner, the risk will be bared by the consignor. Okay. So in case of a consignor, normally risk remains with the consignor in the event of goods being lost or destroyed. Coming to the relationship. So the relation between a seller and a buyer will be of a debtor and a creditor. Suppose if it is a cash sale, so the relation between the person will be the seller and the buyer. Suppose if it is a credit, if you are selling the goods on credit, then the relationship will be creditor and the debtor. In the last previous classes, we might have seen in bills of exchange, the goods are sold on credit. So when the goods are sold on credit, the drawer becomes the creditor and the drawee becomes the debtor. Okay. In case of this credit sale also, here we'll be having the relationship as creditor and debtor. So coming to the, what do you call it as consignor and consignee relationship, we call them as principal and agent. Principal and agent. So the relationship between the consignor and the consignee is that of a principal and agent. Okay. Now let us see the another difference, that is goods return. Usually sold goods cannot be returned back. Okay. Unless and until there is a defect, manufacturing defect or technical fault, the sellers may not be taking back our goods. When once we purchase an article, if it is in good condition, the manufacturer may not be taking back our article. We may not be able to return. Suppose if you want to return the article, they may not be giving cash. In that place, they will be asking you to purchase another article. Suppose if there is manufacturing defect or any technical defect, then the manufacturer may be taking back our goods and it will be replaced by another article. That means it will be replaced by the article which does not have any manufacturing defect or technical fault. Okay. But here in the consignment, consignee may return the unsold stock. Suppose if the goods are not sold, so this stock may be sent back to the consignor at any time. Okay. So we will have in the sale, we can't return the goods, but in consignment, the consignee can return the goods if it is not sold off. So it can be returned to the consignor. Okay. Can you able to understand?
Yes, ma'am.
Okay. Now let us see some important terms in consignment. Important terms in consignment. So some of the important terms we will be learning are pro forma invoice. Pro forma invoice. So what do you mean by invoice? Actually, invoice implies that the sale has taken place. If you have sold some of the goods to the other person, you will be writing an invoice about the quantity of goods that was sold at what price and what is the total amount that the seller has paid. So it implies the sale that has taken place. But in pro forma invoice, it is not an invoice. We do not call it as an invoice. We call it as a pro forma invoice. So here pro forma invoice is a statement prepared by the consignor of goods showing quantity, quality, and price of the goods. Consignor, it will be prepared by the consignor, which shows the goods, its quantity, quality, and price of the goods. So such pro forma invoice is issued by the consignor to consignee regarding the goods before the sale actually takes place. So before it takes place, this consignor will be preparing a statement that how many goods he is sending at which price and what is the quantity and what is the quality of those goods. So all these will be sent through a statement. So that statement we call it as pro forma invoice. Now let us see another term that is called as account sale. So the statement showing the details of goods received, goods sold, expenses incurred, commission charged, remittances made, and a due balance. We call it as account sale. So it is remitted by the consignee to the consignor. If you take the pro forma invoice, it is a statement that is prepared by the consignor and it will be sent to the consignee. Whereas in account sale, all the details regarding the goods received. So how many goods that was received by the consignee. He will be giving details about the goods that was received and goods that were sold by this consignee and expenses that are incurred by the consignee and commission that was charged to the consignee. If there are any remittances made, all these remittances and due balance, all these will be prepared. All these details will be given in a statement, and that statement we call it as account sale. So on a periodic basis, this consignee will be sending this account sale to the consignor. Now let us see the another term, that is commission. Actually, there are three types of commission payable to consignee on sale of goods. One is simple commission. So this is usually a fixed percentage on the total sale calculated as per mutually agreed terms. So the consignor and consignee will be coming to an agreement that a fixed percentage will be paid to the consignee on sale of goods. So that we call it as simple commission. And coming to the overriding commission. So in case of an extraordinary sale of goods, some specific amount is payable to consignee in the form of an incentive that we call it as overriding commission. Sometimes this consignee will be selling the goods by incurring some expenditure or some advertisement, or extraordinarily he will be selling the goods. So for selling those goods, in order to give some incentive to this consignee, we call that commission as overriding commission. So this overriding commission will be calculated on total sales. Overriding commission is calculated on total sales. Now let us, this is for incentive. So for the incentive purpose, to encourage the consignee or to motivate the consignee, they will be paying the, what do you call this as? Commission. So that commission we call it as overriding commission. And coming to the delegatory commission. So delegatory commission is paid by the consignor to his consignee for taking additional risk of recovery of debts from the consignee on account of credit sale made by him. So actually this consignee will be doing credit sales. So the other person will become the debtor. So this consignee will have to recover all those debts. So in that case, he will be taking some additional risk for recovery of those debts. So in order to, so that for taking those additional risk by the consignee, this consignor will be paying delegatory commission. Okay. So on behalf of the consignor, this agent will be taking some additional risk. So in order to encourage that person, in order to recover those debts, this consignor will be paying the commission that we call it as delegatory commission. The other thing is direct expenses. The other term, we call it as direct expenses. So direct expenses increases the cost of goods and are of non-recurring nature and incurred till the goods reach the warehouse of consignor. So this consignor will be incurring some expenditure. So these expenses increases the cost of the goods. Actually, these expenses are non-recurring in nature. So the expenses that are incurred till the goods reach to the warehouse of the consignor. From the warehouse of the consignor, from the manufacturing of the goods, and from there to the warehouse of the consignee, the expenses that are incurred by the consignor, we call them as direct expenses. And coming to the indirect expenses. So in the indirect expenses, that is warehouse rent, storage charges, advertisement expenses, salaries, etc. All these comes under indirect expenses. So you will be paying warehouse rent. Sometimes some storage charges will be incurred. In order to increase the sale, you will be incurring the advertising expenses. You will be paying salaries to the warehouse employees. All these comes under indirect expenses. So distinction between direct and indirect expenses are important, especially at the time of valuation of unsold closing stock. So when there is unsold closing stock, so if you are valuing the unsold closing stock, here we will be considering direct expenses and indirect expenses. Now let us see the another term, that is advance. Amount paid in advance by a consignee to consignor as security is called as advance. Sometimes the consignor may be sending the goods to the consignee. So in order to provide security to the consignee, this consignor will be paying some advance to the consignee. Sometimes the consignee will have to incur some expenses. So to incur those expenses or to give some security to the consignee, this consignor will be paying the amount. So that amount we call it as advance. The other term is valuation of unsold consignment. Valuation of unsold consignment. Valuation of unsold consignment or stock will be done like closing of a trading concern. So in the last year, you might have learned about the trading profit and loss account and the balance sheet. So
Yes, ma'am.
in that you will be valuing the closing stock. The valuation of closing stock that was done in the trading concern may be the same in the consignment account. Okay. This will be valued at the cost or the market price, whichever is lesser. Sometimes they may take the cost price or market price. So while comparing these two, whichever will be lower, then we will be considering that value. So this stock will be valued at proportionate cost price, proportionate cost price, and proportionate direct expenses. Proportionate direct expenses. Here, proportionate direct expenses means all expenses incurred by the consignor and the expenses of the consignor. Okay, all expenses incurred by the consignor and the expenses incurred by the consignor. So after reaching the expenses, the consignee may incur some of the expenses with regard to the consignment. So the expenses incurred by the consignee will also comes under direct expenses. So which are incurred by him till the goods reach the warehouse. So he may be getting the goods. So in between, these goods will have to be transferred to the warehouse. So the expenses that were incurred by the consignee till it reaches the warehouse. So those expenses we call it as direct expenses. So we will be considering the proportionate cost price and the proportionate direct expenses. So these proportionate direct expenses include the expenses of the consignor and the expenses of the consignor. Now the other term, that is invoicing goods higher than cost. Sometimes this consignor will be invoicing the goods higher than the cost incurred by him. So under this method, goods are charged at the cost plus profit, and the pro forma invoice also shows the higher price of such goods, cost plus profit. So cost plus profit. So in the pro forma invoice, the consignor will be showing the higher price of these goods. So to know the actual profit at the end of an accounting period, consignment account will be rated with excess price surcharge. So here, actually you have to send the cost that was incurred by the manufacturer. But here, in order to hide the profits from the consignee, this consignor will be charging the cost plus the profit. And he will be giving the pro forma invoice with higher price of those goods. So while doing accounting for this consignment account, so excess price will be charged. Excess price will be credited. So value of stock will also be adjusted to the extent of profit element. Sometimes if you are valuing the stock, again the valuation of stock will also be adjusted to the extent of profit earned. So why this consignor will be charging this higher price than the cost is to hide the actual profit from the consignor. To hide the actual profit from consignor. And also the other reason is valuation of a stock at the consignor's warehouse is comparatively easy in this case. So if you want to value the stock, then the consignor will be very easily comparing the stock. And the other one is a consignor usually directs consignee to sell goods on invoice price only. Whatever price that was charged in the pro forma invoice, the consignor will be directing the consignee to sell according to that price. So it prevents a different sale price to different customers. So to avoid this, the consignor will be charging higher price on the cost. Okay. Now let us see the loss of goods. Loss of goods. So there are two types of losses. One is normal loss. Normal loss. So normal loss may occur due to inherent characteristics. Inherent characteristics like evaporation, drying up of goods, etc. For example, if you take the petroleum products, so these petrol may be evaporated. Understood? So this is called as normal loss. So sometimes it may be drying up. If you take the sugar cane, if this sugar cane juice will be dried up during transportation. Understood? So these are called as normal losses. So it is not separately shown in the consignment account, but included in the cost of goods sold and the closing stock by inflating the rate per unit. So while doing the consignment account, actually may not be showing this separately in the consignment account, but this will be included in the cost of goods sold. Cost of goods sold, and also in valuing the closing stock. So while valuing the closing stock, you will be inflating the rate per unit. How much rate it was evaporated, or how much loss you have incurred per unit. Now you can calculate this by using the formula, that is, this is the formula: closing stock equal to total cost of goods plus non-recurring expenses of consignor and consignee by divided by total quantity of goods sent minus normal loss into unsold stock. into unsold stock. See, total cost of goods plus non-recurring expenses of consignor and consignee divided by total quantity of goods sent divided by how much quantity you have sent to the consignee, total quantity of goods sent minus normal loss. Normal loss may be some certain percentage, normal loss into unsold stock. Into unsold stock. Okay. Or you can calculate like this also. Total value of goods sent by net quantity received by consignee into unsold stock. If there is no loss, you can calculate like. So net quantity received. Net quantity received means net quantity received equal to goods consigned quantity minus normal loss quantity. Net quantity received means goods consigned quantity minus normal loss quantity. Or you can follow this formula, the same formula. Total cost of goods plus non-recurring expenses of consignor and consignee by total quantity of goods sent minus normal loss into unsold stock. Okay. Now let us see the abnormal loss. Abnormal loss. So an abnormal loss may occur due to any accidental reason. Any accidental reason. Accidentally it may happen. That so it is created in the consignment account to calculate actual profitability. Whereas in normal loss, you may not be taking into consideration the loss incurred while preparing the consignment account. It is not separately shown in the consignment account, but it will be included in the cost of goods sold and the closing stock by inflating the rate per unit. Whereas in abnormal loss, here as it may occur due to accidental reason, it is created in the consignment account to calculate actual profitability. So valuation of closing stock is done on the same basis, that is a proportionate cost plus proportionate direct expenses. Proportionate cost plus proportionate direct expenses. Like this, we can calculate the closing stock. Now let us see abnormal loss and the insurance. Sometimes the consignor may be paying premium. Consignor may be paying the premium in order to avoid, in order to overcome these losses. అలాగే ఎలాగే రావట్లేదు.
Is the class finished?